Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. So pleased to be with you and joined by my co-host, Brian London in New Orleans, Louisiana. We have one of our favorite guests back this week, Mike Larson, a senior analyst with Weiss Ratings and a speaker at the New Orleans Investment Conference, a fellow graduate of Boston University, and a widely cited commentator on financial developments. Mike, welcome back to the show.
Thank you.
I've been following your work, which is great. People can follow you, Real Mike Larson, on Twitter, or go to weissratings.com. And you've mentioned both a renewed tech bubble and an everything bubble. Now, when I hear of a tech bubble or enthusiasm for tech stocks, why does that have to be temporary? Why couldn't this just be a long-term or permanent change that tech stocks just are of interest permanently? Yeah.
Sure. I think the real issue right now comes down to valuations, both basically qualitative investor behavior and quantitative hard facts. I mean, just to touch on a few things, if you look at what's been going on in technology lately, for example, you've had recently the longest stretch of the greatest percentage of money-losing IPOs, mostly tech and biotech, that we've ever seen in the history of the market. Essentially, I mean, with all these IPOs that have been coming out, Uber, Lyft are some of the bigger names, but there's many, many more smaller companies in the tech and biotech space, as well as some of these Chinese IPOs. And the only thing they have in common is that they're all, or almost all, losing money. If you look at basically 2018 and early 2019, you have about 85% of the companies coming public that in the 12 months preceding their IPOs, they lost money. Most of those companies also lost money the year before, and some of them, including Uber, have never made a penny in profit in a decade of operation. So it's not like this is some startup in the garage where somebody's, going to lose money for a little bit or a short period of time and then make money. These companies aren't making money now. They didn't make money last year, and many of them haven't made any money at all since they became a company. The only time we came even close to this was at the peak of the dot-com bubble, where it was also 85%, and we all know what happened next. So that's, one of the signs that this is going on. Another sign that I kind of looked at was if you look at the first 4 months of this year, there's some astonishing moves that we've seen in terms of the NASDAQ and the semiconductor ETF, the benchmark, sector within tech. You had, on an annualized basis in the first 4 months of this year, you had the NASDAQ overall up about 87%, and the semiconductor sector on track for 154% gains. Again, that's annualizing 4 months of results.
My question, was basically, why is this temporary? And you just think it is temporary because people cannot sustain losses forever. Is that the basic logic? Yeah,
exactly. And if you look at what happened in the first 4 months of this year, right, you had the semiconductor sector that was on track. Basically, it was up 33% in the first 4 months of this year. That's equivalent on an annual basis to about a rise of 154%. Now, if you go back throughout the entire history of the semiconductor sector or the tech sector in general, the only year that even came close was 99, the peak bubble year, and the semis were up 101% then. So again, you're talking about tech stocks. So much money was being thrown at tech early this year and thrown at other growth stocks in general. You had rallies that would have been on track to eclipse what we saw in 99. That's just nuts. The valuations on these companies don't make sense. The optimism about their future being priced into them doesn't make sense. And again, when you see all this reckless behavior and investing behavior going on, especially with what's happening in the IPO market, it tells you that you have a real problem on your hands.
I did see a recent presentation from you, and it just gave me a heck of a lot to unpack in this domain. And one of the key points which I thought stood out, and maybe other people were not referring to or have not heard discussed, is the use of fudged or fake numbers in these IPO in the IPOs. And was it only in IPOs that you were seeing fudged numbers? What you called, I think, add backs? What are these?
Oh, sure. No, that's actually, how my general thesis is that what's happening in tech is where some of the greatest nuttiness is going on. But the problem is the sort of bubble-like behavior in lending, investing, and borrowing spreads to many other sectors as well. What's happening with those add backs, that actually goes to some of the corporate takeovers we're seeing, the leveraged buyouts. You have so much money that's poured into these venture capital and private equity firms that they're paying higher and higher prices for companies, and they're having to justify the prices they're paying by coming up with all kinds of made-up numbers. You referenced that one thing. Basically, of all the deals that were transacted in early 2018 by these corporate buyout firms, about 26% of them had to use these things called EBITDA adjustments, which is a fancy way of making up numbers to make them look and sound better so you can justify why you're paying so much. The historical average, or what you saw years ago, it was more like 5, 6, 7, 8, 9% of these deals that had this. So again, you have almost 3 times as many deals that have these sort of fake numbers being used just to justify the prices paid than you've ever had before. And that just is another example of how there's really some reckless behavior going on, and how I think we're very late in this cycle, and this is the evidence of it.
Right, and another interesting ingredient was the rise of corporate debt. There's so much to say about this. You mentioned that there's an increasing proportion of corporate debt is high risk, that it has doubled in size in the last decade, and that fewer corporate loans are requiring the same security as in the past. Why all this corporate debt? Why is it rising so much? Why is this becoming more ubiquitous?
Sure. Well, if you look at the overall value of corporate debt outstanding, it rose coming out of the last recession in 2008. There's about $3.4 trillion worth of corporate debt outstanding. That's non-financial debt. That surged 82% to $6.2 trillion at the end of 2018. So, you had an expanding economy, which generally leads to some increase in debt. But in the early 2000s, you saw nothing like this. The economy was growing. Corporate debt went up a little bit, but it was nothing like this. We're talking 82% increase in just, 10 years. Now, on top of that, you're looking at a greater and greater percentage of that debt being issued to lower and lower rated companies. And when those companies are taking out the debt and investors are buying it, those investors and those lenders are getting less and less protection. There's less restrictions on what the companies can do with the money. So again, it's not just a surge in the quantity of corporate debt, it's a dramatic decrease in the quality of that debt. So this garbage paper is full up in a lot of mutual funds, ETFs, and other types of investors have been purchasing this. And it's unfortunate that that's really going to set the stage for some major issues down the road in terms of defaults, delinquencies, and losses.
Yeah, looking at that, Mike, you've been predicting that the next crisis won't be begun or won't start in mortgage debt like it did in 2008, but that it will be corporate debt. But won't it be worse somewhat because this corporate debt was largely, or a good percentage of it was used for corporate stock buybacks, and this in turn has helped fuel a real advance to record heights in the U.S. equity market. So I'm seeing a lot of dominoes here that could fall if we do have this kind of a crisis.
You're absolutely right. I mean, there's nothing theoretically wrong with borrowing money as a corporation if you're going to put it to productive use. You want to build a factory, you want to spend it on research and development, things that are, because of those efforts, going to generate revenue, earnings, and the money to pay that debt back down the road. But when you're just squandering it on buying your own shares, so it makes the CEO more money, or it makes the large shareholders happy, that's non-productive investment. It's money that, sure, it might help in the short term drive your stock up, but it doesn't leave you with the great shiny new factory in a few years or a new headquarters building or anything else.
It's just going to go away. It's going to money heaven along with the values of the U.S. equity market that it supported.
Exactly. I mean, there's all these risks have been piling up for a while, and certainly I've been concerned about them. But I think what you've seen since early 2018, too, is a change in the market character. A lot of these risks are now starting to be acknowledged by other investors. It's starting to show up in sort of the behind-the-scenes technical indicators and some fundamental indicators for this market. So I think that's why I've tried to be even more vocal about warning about this, because there are things you as an investor can do to protect yourself. And I think that those types of steps are really more important now than they've been probably at any point in the last 10 years.
Your mantra before was boring is good, or something about being boring. But do you have any other additions or more, do you want to be more precise about that?
Sure. It's funny that you mentioned that. I mean, in the old Gordon Gekko movie, Wall Street, the catchphrase was greed is good. And during the long economic expansion and the long point where these risks were building up or were smaller, that actually made sense. But now I wholeheartedly think that boring is good, and boring will make you money. Boring is what's been working in this market. I mean, if you look at longer term, really since the sort of January 2018 blow-off move in the stock market, we've essentially gone sideways with a couple big drawdowns. But what's been happening behind the scenes is a lot of those sectors that do well in an expanding economy when risk-taking is increasing, those are underperforming. Your financials, your materials, transportation stocks, and so on. What's been taking the lead and what's been doing much better is the boring stuff. It's some real estate investment trusts. It's utilities. It's consumer staples. Companies that pay nice dividends, that have recession-resistant business models, that have sort of steady Eddie type practices, as opposed to these companies that are really flying close to the sun. So I think as an investor, that's the type of things that you really want to own these days, whereas 18 months ago, that wasn't the case. And on top of that, you can look at some other things like gold that offer you protection, or as I like to call it sometimes, chaos insurance. In a market where volatility is going to be going up, risk is going to be, risk-taking appetite is going to go down. Things like gold and gold mining stocks give you great protection against the possibility a lot of this stuff is going to go sideways.
So, Mike, what do you see as the how all this is going to play out? Because it seems to me that if we're in kind of an everything bubble that's been fueled by just, literally unprecedented monetary reflation and stimulus, that at some point what we're going to have is another bust that, of course, is going to demand more monetary stimulus to try and get out of it by the central bankers. But we will have a major asset class-wide, financial markets-wide bust. And in that kind of scenario, your switching allocations into more defensive sectors like real estate trusts, et cetera, aren't those actually going to be thrown out with the bathwater as well in that kind of a scenario? Or are you saying that these are more defensive, therefore you will lose less and they will be the first to recover?
Sure. I think what you're going to see, or what you are seeing, is a transition, right? A process that plays out in phases. If you go back to something like the 2000 to 2003 bear market, the S&P 500 ultimately lost 50-some-odd% of its value. But it didn't all happen overnight. And what's interesting to know is in the first year of that bear market in 2000, if you own tech stocks, you got killed. The main tech ETF was down 42%. But in that very same year where tech was down 42%, the REITs and the utilities were up about 22%. So again, you're talking a 64 percentage point difference. And that was a transition phase. Ultimately, the downside pressure got too great, and you lost those sectors as well. And I think that probably at some point we're going to see even some of the safety type names get dragged down. And you're going to see that as the economy slows, which is sort of my next expectation, that we're going to see a recession in 2020 or 2019. That's when I think you're going to have more issues with the broad market overall. I think in this phase, though, your best bet is to at least play along with some of the sectors that work. Make sure you have those defensive, protective type investments. Make sure also that you're carrying much higher cash levels. It's not just a question of being 100% long in tech stocks and then moving to 100% long in utilities. It's something where back in early 2018, I pretty much told people, readers of our Safe Money Report and people who read our free column and so on, I've personally moved to the highest cash position I've had in many, many years, and I think that's what you want to do also. So, you're dialing down your risk. You're moving from riskier stuff to more defensive companies. And then at some point, I don't know if you say you sell it all, but you get even more defensive than that. And that it's a process that plays out over time.
This episode is sponsored by the New Orleans Investment Conference and Gold Newsletter. For over 40 years, investors have relied on both of these institutions to get timely intelligence from the world's top experts and to discover tomorrow's biggest winners in metals and mining. Visit NewOrleansConference.com and GoldNewsletter.com to learn more.
Mike, you have, I don't know if you were the first person to use the term everything bubble, but you were certainly the first person I heard use it. And I think you've been the most persistent and eloquent commentator on this trend over recent years. And you did a great job at last year's New Orleans Investment Conference and kind of detailing why it's the everything bubble, and then even into some other alternative investment classes. Can you give us, kind of recap that for our listeners a bit to give them a feeling of how, how widespread this bubble has become this time around?
Sure. I mean, you go back to what happened in the late 1990s, and it was largely technology stocks, .coms, and so on that had the biggest run-ups and the biggest collapses. And then obviously we all know in the mid-2000s, it was, the crisis then, or the bubble then, was focused on mortgages and residential real estate. What's happened this time is you have not only those two asset classes. I already talked obviously about technology, but if you look at residential real estate, I mean, house prices nationwide through last year were growing at a much faster rate than incomes for 5-6 straight years. Some of the high-end markets, I mean, you look at high-end real estate, these billionaire buildings that have risen out of the ground in Manhattan. You look at some of the houses in California, they were asking $150, $200 million for Bel Air mansions. So you're seeing it in real estate, especially at the high end. And you're also seeing it in all these kinds of esoteric assets, stuff that a lot of people don't follow, but I've been pulling together all this data, and it points in the same direction. One example would be sports cards, baseball, football cards, and so on. There's actually a company that tracks an index of these things, and it was up 265% in value during this sort of everything bubble, which was more than 2.5 times the S&P. If you look at the value of NFL teams, trophy assets that the billionaires want to buy, the average NFL team surged in 2013 was worth about $1.2 billion. In 2018, it was worth 2.6. So more than doubling in value of again, a trophy asset like that. Or even in artwork. You've got, Banksy, that UK artist that nobody really knows exactly who he is. I mean, he had that girl with balloon painting that was estimated to went to auction with Sotheby's in October 2018. It was estimated to be worth about $263,000 to $400,000. Then it sold for $1.4 million. And then somebody in the audience pressed a remote control button. The thing got shredded, and it was like, oh, gee, this is horrible. No, wait, actually, it makes this thing more valuable in tatters than it was intact. You're seeing all kinds of examples of this nutty behavior. And again, it's not, of course we talk about stocks, of course we talk about risky bonds and so on, but you're seeing it in all these collectibles and artwork and all this other sectors. So that's why I think you really look at it as, again, a more encompassing situation than just, hey, it's tech stocks, or just, hey, it's housing like last 2 times.
Yeah, we saw a chrome rabbit sell for, $90 million or something. The record for a living artist. I mean,
exactly.
If I was a living artist and I saw a chrome rabbit sell for $90 million, I think I'd go back in the shop and just build another one, wouldn't you?
Exactly. And that's happening all over. So that really does speak to the breadth of this situation and how it's all kind of tied together.
Now, Mike, you've been talking about this tech bubble pretty relentlessly recently. But, back in the late 90s, I think everybody knew that we were in a tech bubble when you had pets.com, socks.com, any noun with .com behind it getting, $100 million valuations right out the gate. Everybody knew we were in a bubble. We just didn't really know when it was going to end. We were going to, some people at least were going to ride the wave as long as possible. But right now, I don't really see, correct me if I'm wrong, I don't see a lot of people talking about a tech bubble right now. The whole thing with the semis was unbelievable to me. Do you see this? You just mentioned that more and more people are starting to talk about it. But is it really that widespread right now? Are people really getting worried about it?
I really think that we've entered the terminal phase and are probably, seeing this top out as we speak. And a couple reasons why. First of all, obviously the biggest, flop in a high grade IPO or sort of a front and center name with Uber. The whole process was a fiasco in terms of what happened with the IPO pricing, dropping on its first day. Even the underwriters couldn't support it despite all this money thrown at the market. That very much reminds me of sort of that moment in January of 2000 when AOL and Time Warner announced they were going to merge. It was like a $160 billion transaction. And that sort of, that news event came a couple months before the actual NASDAQ started to roll over. But what's interesting is it came in the wake of a lot of stuff going on behind the scenes. I actually worked at a .com in the late 1990s that came public in May of 1999. The stock went nowhere in the IPO and then just started to steadily fall. That month, many other sort of second and third tier names started rolling over too. So you saw a lot of these formerly hot IPOs that were falling apart 8 to 9 to 10 months ahead of the NASDAQ. And what's interesting is the same thing's been happening now. Again, everybody's been focusing on Uber, but last year there was a slew of junky biotechs, money-losing Chinese companies, the Netflix of China and all this other kind of stuff going on. if you look at how those companies have performed, their stocks are down 30, 40, 50, 60% from their post-IPO pop prices. So it's already happening on the smaller, less covered names. Now you've had this big failure by Uber, and on top of it, you have, other companies that are right behind there in the chute trying to come public, the WeWorks of the world. They're asking for these ridiculous valuations, and I don't think they're going to get it. So the reason I've been so vocal about it, especially in the last 6 to 12 months, is that it's not just, hey, this thing's been going on, maybe someday you should be concerned about it. It's, hey, this is going on, it's getting worse, and by the way, there are some cues that this thing is starting to leak air. So that's why I think it's more important now as an investor, not just to be worried about it, but to take actual action to protect yourself from it.
Mike, one thing that you noted, obviously, you emphasized the easy money or easy credit as a big contributor here. Why do you think that has gone into assets rather than consumer spending?
It's interesting. We've had a larger and larger series of sort of these market bubble environments where the central bank's response, both here and globally, has been to throw money at the problem after whatever, fill in asset class A falls, let's throw money at it. And what's happened is the real economic response hasn't been all that great. I mean, it's been many, many years that the Fed really has failed to hit its 2% inflation target. If you look at what's happening in Europe and Japan, they've done even more on a relative basis in terms of, not just buying treasury bonds, but buying corporate bonds, buying stocks, and so on. And what's happened? Their inflation rates are nowhere near the target years and years later. And they've had negative interest rates thrown at it too, whereas we were so prudent to stay at, 0 to 0 or to 25 basis points. I think what this proves is that the money is being, whatever word you want, sidetracked, hijacked, whatever the term you want to use. But it's getting sent to asset markets as opposed to the real economy. And the problem with that is it can last for a while. It can last for a long while. The market can remain irrational longer than you can remain solvent. But if you're not getting the actual real economic response you want, eventually it runs out of gas. And I think that's kind of what we've seen since early 2018. I mean, I don't think it's a coincidence that the market's been sort of topping out. We've had some big drawdowns. Volatility's picking up. And again, not just things like IPOs, but the high-end real estate market is now leaking air. There was just a report the other day about a guy trying to, that had done one of these Bel Air mansions that he wants $180 million for. Well, now he's on the wire saying he'll take $120 million. I mean, that's a $60 million cut, or about a third of value off one of these trophy homes. That's the type of stuff you're starting to see. And I think that's the evidence that the trend has turned or is in the process of turning. And that's very important.
I had the pleasure at a conference in Las Vegas, the Money Show conference last week, to sit at the blackjack table with Mike. I have to say that I was always impressed with his market analysis, but after sitting at him with the blackjack table, I'm even more impressed with how quickly he thinks on his feet or on his stool, and in how 180 degrees it is away from his investment philosophy, which is not gambling by any means. So I guess you let it all out on at the blackjack table, huh, Mike?
Exactly. With my own fun money or whatever, sure, I'll try and have some fun at the casino occasionally. But with investors' dollars, that's a whole different story.
Well, you run the numbers in your head very quickly, and perhaps we'll look forward to more of that on our cruise later this year at our gold cruise in December. And of course, we'll have you back at the New Orleans conference this year as well. So we'll be seeing a lot of you.
I'm very excited. I can't wait for all those events.
Yeah, and I'd like to finish off with just a juicy quote from you, Mike. I just got your release today, and it says, "What goes up must come down." I'm sure you've heard that expression a million times before. But for today's stock market, a better version might be, what takes off like a Polaris missile with no downside protection and no margin of safety is doomed to crash back to earth. So I guess some reality check will be coming soon. Mike, we appreciate your time. Thanks so much for joining us.